Every mortgage broker loves to tell you that real estate debt is good debt because tenants pay it off while the property appreciates. It sounds like a law of nature, right? You put a little bit of money down, the bank covers the rest, and time does the heavy lifting. But the math has teeth. Most people treat leverage like a ladder that only goes up, but in reality, it is a high-tension cable. The moment the total return on your property falls even 1 percentage point below your borrowing cost, that cable snaps. Leverage stops being your friend and starts amplifying your losses with terrifying efficiency. You are not just losing equity, you are bleeding cash. This shift from wealth builder to toxic liability is not a mystery or a matter of bad luck. It is a set of specific breaking points on interest, cash flow, and equity that you can see coming if you know where to look. Today, I want to show you exactly where those lines are drawn so you can stop treating debt like a slogan and start treating it like the volatile tool it actually is. We are going to deconstruct the myth of good debt and look at the math that turns a safe investment into a financial landmine. Before we dive into the spreadsheets and the hidden risks, I want to be clear about why we are doing this. Most people spend more time picking out the paint colour for a kitchen than they do stress testing the debt that pays for it. If you get this math wrong, a 5% drop in the market can wipe out 100% of your hard-earned savings. Checking these numbers is quite literally the best return on your time you will ever find. I have spent years looking at these patterns, and I have seen how quickly the tone changes when the market softens. If you value this kind of deep dive into the mechanics of money, the best thing you can do is stick around for the full breakdown. We are going to go slow, we are going to be thorough, and by the end, you will have a protocol for your own portfolio that most professionals completely ignore. It is about moving beyond the surface level advice and understanding the gearwork of wealth. Let's start by looking at what the banks call good debt and why that definition is dangerously incomplete. If you ask a traditional bank or read a mainstream finance blog, they define good debt with a very simple checklist. They say it is debt used to buy an asset that appreciates or produces income. Think of a mortgage, a business loan, or even a student loan for a high-earning degree. The logic is that the borrowing cost is lower than the asset's expected return, and the cash flow from the asset can comfortably service the debt. On paper, it is a beautiful win-win. You use the bank's money to capture the upside of a much larger asset than you could afford on your own. Real estate is the poster child for this. We see examples of people using liquid asset secured lines or low-rate mortgages to scale their portfolios. They show you these clean charts where the rent covers the mortgage, the taxes, and the insurance, leaving a nice little pile of profit at the end of the month. It feels like a safe, predictable machine. The mainstream view assumes that as long as the asset is productive, the debt is automatically good. But this definition misses the most important variable in the entire equation: the margin of safety. It assumes a static world where nothing goes wrong. And as we both know, the world of real estate is anything but static. The problem with the good debt label is that in a spreadsheet, nearly any loan can be painted as a winner. You just have to make a few standard assumptions. You assume high perpetual appreciation, you assume 100% occupancy, and you assume there will be no major capital expenditures for at least a decade. When you plug those numbers into a model, the leverage looks incredible. It looks like you are printing money. I have seen countless pitch decks for real estate deals that rely on these perfect conditions. They tell you that a 6% interest rate is a bargain because the property will surely go up by 8% a year. But reality rarely cooperates with our assumptions. Air conditioners break, tenants move out unexpectedly, and interest rates do not stay low forever. The breaking point for debt lives in the gap between your spreadsheet and the real world. When your all-in borrowing cost starts to creep closer to your total return, the leverage effect begins to flip. It is a slow-motion transition that most people do not notice until it is too late. The spreadsheet says you are a genius, but the bank account says you are in trouble. Why do we fall for this? I think it is because we want to believe there is a shortcut to wealth. Leverage is the ultimate shortcut. It allows us to feel richer than we are and control more than we own. When things are going well, leverage makes you feel like a financial wizard. If your property goes up 5% and you are 5-to-1 levered, you just made a 25% return on your equity. That feeling is intoxicating. It creates a psychological blind spot where we stop looking for risks and start looking for more debt. We start calling it good debt as a way to soothe our anxiety about the mounting liability. We convince ourselves that because it is for an investment, it is fundamentally different from a credit card balance. While the purpose is different, the mechanics of the math are exactly the same. Interest is a cost, and debt is a claim on your future income. When we stop respecting the power of that claim, we start making speculative bets without proper due diligence. We stop asking what happens if the rent drops and start asking how many more properties we can buy. This is the moment when leverage shifts from a tool to a trap. The first step in de-risking your debt is to stop using the labels good and bad and start using the terms productive and toxic. A productive loan has a clear, documented margin of safety. To find your own breaking point, you need a protocol that ignores the best-case scenario. I recommend a simple 3-part sanity check before you ever sign a loan document. First, assume your expenses are at least 50% of your gross rent. This is a common rule of thumb that accounts for taxes, insurance, maintenance, and management. If the deal does not work at 50% expenses, the debt is likely leaning toward toxic. Second, run your numbers at 80% occupancy. If you need every single month of rent just to break even, you are not investing, you are gambling on a perfect world. Third, compare your total borrowing cost to the unlevered yield of the property. If your interest rate is higher than the cap rate of the building, you are starting in a hole. This is the foundation of the negative leverage effect. By applying these filters, you move away from the myth of good debt and toward a mathematical reality. You are looking for debt that can survive a bad year, not just debt that looks good on a sunny day. Now, if you think that a thin margin of safety is just a minor annoyance, wait until you see what happens when the math actually flips. Most people stop their analysis at the monthly cash flow. But there is a hidden mechanism called negative leverage that can destroy $50,000 of equity in a single afternoon. It is the mathematical equivalent of rowing a boat upstream against a current that is getting faster every minute. We are about to look at a real-world example of a $300,000 rental property to see exactly how this works. If you do not understand the leverage flip, you are essentially flying a plane without a fuel gauge. You might feel fine right now, but the ground is coming up much faster than you realize. Let's look at the hard numbers and the point where the slope of your returns starts to head straight for the basement. At its core, leverage is just the use of borrowed capital to amplify the return on your equity. It is a multiplier. If the return on the property itself is higher than the interest rate you are paying the bank, that multiplier works in your favor. This is what we call positive leverage. Imagine you buy a property for cash and it returns 6%. Now imagine you borrow half the money at 4%. Since the asset is still making 6%, but you are only paying 4% on the bank's half, that extra 2% flows directly to your pocket. Your return on your own money suddenly jumps. This is the dream that every real estate investor is chasing. It is why people are so obsessed with low interest rates. The wider the gap between the property's performance and the loan's cost, the faster you build wealth. It feels like magic because you are effectively getting paid to move the bank's money around. But this relationship is not fixed. It is a sliding scale that depends on the property's net operating income and the prevailing interest rates. As long as you stay on the right side of that line, leverage is a powerful engine for growth. The danger zone begins when the total return on the property falls below your loan interest rate. This is known as the negative leverage effect. At this point, the multiplier starts working against you. Every additional dollar of debt you take on actually reduces your return on equity. It is a counterintuitive situation where being more levered makes you poorer. Think about the math. If the property is only yielding 5%, but the bank is charging you 6%, you have to make up that 1% difference out of your own pocket. You are essentially subsidizing the bank's investment. This happens more often than you might think. When property prices are high and cap rates are low, investors often find themselves buying deals where the income barely covers the interest. They hope that appreciation will save them, but if that appreciation does not materialize, or if expenses rise, they are stuck in a negative leverage trap. The equity return starts to slope downward as the loan-to-value ratio rises. On a chart, this looks like a cross. On one side, adding debt makes you richer. On the other side, adding debt makes you lose money faster. The exact point where those two lines cross is the neutral point, and it is the most important number in your portfolio. Let's put some meat on these bones with a real example. Imagine a rental property with a purchase price of $300,000. You put down 20%, which is $60,000, and borrow $240,000 at 6% interest. Now, let's say the gross rent is $2,200 a month. That sounds pretty good, right? That is over $26,000 a year. But once we apply the 50% rule for operating expenses like taxes and maintenance, your net operating income drops to $13,200. Now look at your debt service. 6% interest on $240,000 is $14,400 a year. Do you see the problem? Your income is $13,200, but your interest payment is $14,400. You are losing $1,200 a year before you even pay a single cent toward the principal of the loan. In this scenario, your property's yield is about 4.4%, but your borrowing cost is 6%. This is negative leverage from day one. To make this good debt, you would need to find higher rents, lower your expenses, or get a significantly lower interest rate. Without those things, every dollar of debt on this property is actively destroying your wealth. You are paying for the privilege of owning an asset that is leaking cash. The protocol for avoiding this trap is to calculate your unlevered total return before you look at financing. You need to know what the property returns on its own merits. Take your projected net operating income and add a very conservative estimate for long-term appreciation. If that combined number is not at least 1 to 2 percentage points higher than your interest rate, you should not be using high leverage. You want to ensure you are in the positive leverage zone where debt actually works for you. I also suggest looking at your equity return as a function of your loan-to-value ratio. If your return on equity starts to drop as you add more debt, that is a massive red flag. It means you are over-leveraged for the yield the asset provides. Don't let the excitement of a new deal cloud this basic arithmetic. Debt is a tool that requires a specific environment to be effective. If the environment changes, if interest rates spike or rents soften, you need to be prepared to deleverage or walk away. Your goal is to keep the leverage slope pointing up, not down. This is how you distinguish a real investment from a subsidized liability. We have talked about the income side, but there is an even more dangerous cliff waiting for you: the equity threshold. Most investors stop worrying once the cash flow is break-even, but that is exactly when the most significant risk starts to hide in plain sight. If you are sitting at 80 or 90% leverage, you are one bad quarter away from negative equity. This is the point where you cannot sell the property and you cannot refinance it without bringing a check to the closing table. It is the definition of being trapped. Research shows that once you pass the 80% mark, the probability of default doesn't just rise, it spikes. I'm going to show you why a small price drop that most people would ignore can actually wipe out a decade of your work in an instant. This is where the optimizers separate themselves from the crowd. If you want to see how to build a safety net that actually holds, you need to see these next 3 thresholds. The first threshold of toxic leverage is the equity cliff. Research from the European Central Bank and various financial institutions shows a sharp increase in default risk once a loan-to-value ratio passes 80%. At this level, you have very little room for error. Think about the math of a price drop. If you bought a property with 20% down and the market value falls by 20%, your equity is gone. You are at zero. But if you bought with only 5 or 10% down, a modest 10% dip in the market puts you in negative equity. You now owe the bank more than the house is worth. This is a precarious position because it removes all of your options. You cannot sell to get out of a bad situation because you would have to pay the bank the difference. You cannot refinance to a lower rate because no lender will touch a property with no equity. This is where real estate moves from a wealth-building tool to a liability landmine. High leverage makes you fragile. It magnifies the downside just as much as the upside. When markets move, the people with high LTVs are the ones who get forced out of their positions, while those with more equity can simply wait for the recovery. The second threshold is the debt service coverage ratio, or DSCR. This is a simple calculation of your net operating income divided by your annual debt service. A ratio of 1.0 means your income exactly equals your debt payments. You are walking on a tightrope. Most professional lenders want to see a DSCR of at least 1.25. This means you have a 25% cushion. If your income drops or your expenses rise, you can still pay the bank without dipping into your personal savings. But here is the secret. Many investors project a safe DSCR based on perfect occupancy. A truly savvy investor stress tests this ratio. They ask, what does my DSCR look like at 70% occupancy? If it falls below 1.0 under that stress, the leverage is fragile. Toxic leverage is when you are cash flow negative before taxes, even in a normal year. This turns every vacancy or repair into a monthly cash leak. It is exhausting and eventually leads to burnout or default. Having a high DSCR is like having an extra tank of oxygen when you are diving. You hope you don't need it, but you're very glad it's there when the unexpected happens. Your goal should be to maintain a margin of safety that allows you to sleep through a recession, not just survive a good year. The third threshold is the volatility trap. We often treat real estate as a slow-moving, stable asset class, but local markets can be surprisingly volatile. A new zoning law, a major employer leaving town, or a spike in property taxes can change your numbers overnight. When you are highly levered, you have no way to absorb these shocks. You are essentially betting that the future will look exactly like the past, but with higher prices. This is a psychological trap because we tend to anchor our expectations to the most recent gains. We see prices go up for 5 years and assume they will go up for 5 more. This confidence leads us to take on more debt and lower our standards for what we consider good debt. But toxic leverage is often invisible during the good times. It only shows its face when the wind changes direction. By then, it is usually too late to adjust. The most successful investors I know are not the ones who took the most risk. They are the ones who built portfolios that could withstand volatility without requiring a bailout. They understood that leverage is a double-edged sword that demands respect. To protect yourself from these thresholds, you need a property reserve protocol. This is separate from your personal emergency fund. For every property you own, you should have a dedicated cash reserve that covers at least 6 months of all expenses, including the mortgage. This reserve is your ultimate margin of safety. It allows you to weather vacancies and price drops without panic. Additionally, you should set a personal limit on your portfolio-wide loan-to-value ratio. I personally like to see it stay below 70%. This gives you a 30% cushion against market declines, which is enough to survive even a severe downturn. Finally, revisit your DSCR every 6 months. If it is trending toward 1.0, it is time to look at increasing rents or paying down principal. Do not wait for a crisis to fix your leverage. Treat your debt like a living part of your business that needs regular checkups. If you can keep your LTV low, your DSCR high, and your reserves full, you have transformed debt from a toxic liability into a productive tool. You are no longer gambling on the market, you are managing a resilient financial system. This is the difference between being a lucky amateur and a professional optimizer. Everything we have talked about today comes down to one thing: having the discipline to look at the numbers even when they are not telling you what you want to hear. If you find this level of granular analysis helpful, I would love to invite you to join our community, the Optimizers. By clicking the Join button, you become a member of a group that values math over hype. Members get priority replies to their comments, which is where we can really dive into the specifics of your own deals. You also get custom sketch badges that show you are part of the core group of people who are actually doing the work to master their finances. It is a small way to support the channel and ensure we can keep producing these deep dives into the mechanics of money. We are trying to build a culture of peer review where we help each other find the breaking points before the market does. If that sounds like your kind of environment, we would be honored to have you. Now, let's wrap this up with a final look at how to audit your current portfolio and what to do if you find yourself on the wrong side of the line. The final step in this process is a peer review audit of your own portfolio. I want you to go through your loans this week and calculate 3 numbers for every asset you own: your current loan to value, your actual debt service coverage ratio over the last 12 months, and your unlevered yield versus your interest rate. If any of those numbers look thin, do not ignore them. The goal is to identify the risk while you still have the power to fix it. Maybe you need to stop buying new properties and focus on paying down high-interest debt. Maybe you need to build up a larger cash reserve. Whatever the answer, the math will lead you there. I would love to hear from you in the comments. What kind of leverage are you using right now? And what is the current DSCR of your best and worst performing assets? Let's treat the comment section like a data gathering exercise. By sharing our numbers and our strategies for maintaining a margin of safety, we can all learn what real-world good debt actually looks like. Remember, wealth is not just about what you control, it is about what you can keep when the world gets messy. Leverage is a tool, not a law of nature. Use it with respect, keep your margins wide, and I will see you in the next one. Let's keep optimizing.